I even buy Alibaba? It is down 22% year to date. We can pretty much see it at the 52-week low. Well, there are a lot of issues with this company over the last few years. We see their founder disappearing for 3 months, someone who is essentially one of the richest men in China. We see articles written where he's been found. We can see here, for example, that he angered the authorities, the Chinese authorities, in fact, and then vanished from the public view. We have articles that discuss the company effectively being down in the dumps with the declines due to regulatory challenges from the US export controls on their chips. There is a lot of negative sentiment with Alibaba and the stock has been punished. But is this a company that really we should even be looking at buying? We're going to take a look at the stock valuation to see whether or not the reward is worth the risk. We'll also analyze some key financial metrics as well as others. But let's start off. It is currently at the 52-week low. It has recently now started a dividend, so the yield forward looking is 1.4%. And if you were holding this over the last 10 years, you can see your gain would be very minimal. However, the 50-week, or in fact the all-time high, did sit around $310. So we're talking more than 4 times the current trading price. So is this even a company that we want to even be looking at? There are a lot of issues, political issues with this company. So let's take a look and see whether or not the risk is worth the reward. Top line, remember 3 to 7%, so we'll look at their latest earnings to see how they've performed. 56 billion in March 2019. The latest annual report, March 2023, 126 billion. So this company is growing very nicely. In fact, more than doubled their top line over the last 5 years. On a more granular level, we do see an increase to 2022, quite strong year on year, before falling slightly in 2023. But over the last 5 years, it has been a very strong growth machine. Now, how does the bottom line look? Well, 13 billion reported in 2019, around 10.6 billion. So their bottom line has in fact decreased over the last 5 years. We do see it in fact increased from 2019 to 2021 before dropping quite dramatically and again increasing very minuscule in 2023. So they are having a very nice bottom line, but it has decreased over the last 5 years. So some mixed sentiments there. Now, in terms of the balance sheet and the health of this company, well, 30.3 billion in terms of cash and short-term investments in 2019, 79 billion from their latest quarterly report. So they hold more than twice as much cash as they did over the last 5 years, and quite a significant chunk. Now, in terms of their total debt, how does that compare numerically and directionally? Well, 20 billion in March 2019. Yes, it has increased by 7 billion to 27 billion in their latest report, but they still do hold a phenomenal amount of cash, more than they do total debt. So a very quick look would show that the balance sheet is very healthy. Now, in terms of performance versus some well-known in the broadline retail sector, what we can see is they have been hit very, very poorly. Down 22% year to date. Although they're not the worst performing, it is still a very poor return on your investment. When we extend this over the last 5 years, we do in fact see again a very poor return. Not surprised based on what we saw at the beginning of the episode. So down 54%. So not only bearish sentiment around the company, but we also see a very poor return. But remember that past performance is never an indicator for future results. So institutional ownership, it's around that 14% mark. Yes, around 5.7 billion worth of shares have been sold by these institutions over this period, but we can see around 9.4 billion bought during the same time. So institutions are buying more than they are selling, and we can see that clearly in Q3, although note in Q2 it was the opposite, with Q1 and Q4 showing signs of more buying than selling. So whilst the institutions may be buying more shares than they are selling, it doesn't necessarily mean it's one we should buy, and always understand the risk associated. So yes, we do see right now they have just started paying the dividend, so we don't have a dividend safety score, and the market cap sits around 182 billion, so it is a mega cap company. Now, in terms of looking at some financial metrics, in terms of their free cash flow payout and what is expected, it is going to be around 11%, so very minuscule. So I would expect the dividends to increase over the next few years. Double digits is what I would see. This is very, very low, so I'd like to believe that this will be a very strong dividend grower. But when we take a look at the free cash flow per share, we do see an inconsistency, a drop from 21 to 22, and even though 23 hasn't increased higher than the 2021, from 2014 where it was just shy of $10, it has increased by more than 10 times, with 2024 expected to go even higher. So very nice free cash flow per share increase year on year for Alibaba. Sales growth, now this is positive and negative. They had some very, very strong growth from 2014 all the way even to 2022, you could argue, but it has slowed down in 2023. Now, could you argue that this is a blip? Is this a one-off? Or is this something we're going to expect going forwards for 24 and beyond? Will we see this top line come down to single digits and not what we have come to love with this company with very high double-digit year-on-year increase? Now, total sales, 53 billion for those who want to see the numbers, 870 in 2023, so extraordinary growth over the last 10 years, which does make you question whether or not this company of this size will be able to continue increasing their top line. Shares outstanding, now they have diluted your position as a shareholder if you had owned these from 2014, as they have increased these by over 300 million, so something just to bear in mind to understand the pattern of the company. ROIC, personally, 10% or more is what I like to see. Gives me faith management are able to effectively allocate their capital. Now, realistically, over the more recent term, it hasn't hit that 10%, but 8%, 7% I could live with if there were a lot of other positive signs of the company. Free cash flow margin, operating margin. Now, yes, it is nice to see these high numbers, but it has started to come down again. Something I would keep an eye on. I would like this to come back up to around the 20s that we did see over the last 10 years. Free cash flow margin, again, it has started to come down. So it does just make you think you have to have all of these in your mind when you are analysing whether or not the risk-reward ratio is good for this company. Net debt to EBITDA, essentially signalling the strength of the balance sheet and the dividend safety. What this effectively signals is the number of years it would take the company to pay off all of their debt net of cash on hand. And what we can see for 2023, it wouldn't even take them 1 day. So their balance sheet is very strong. The dividend is not only safe, but also it does have a strong balance sheet going forwards. Now, in terms of their essential quarterly earnings, what we can see over their last Q3 earnings, they beat on the essential earnings per share. However, they did have a miss on that revenue. A little bit of a worry. It was a very small miss, but as I said, we don't want their revenue to start slowing down, especially how strong it had grown. Q2, we see a large miss, in fact, on the earnings per share, and they did, in fact, beat on the revenue, so opposite to what we saw in Q3. And in terms of Q1, what we do note here is that they actually missed on both top line and earnings per share. So not the greatest earnings they've had Q1 to Q3 this year, but when we do take a look at a quick analysis of Q3 23 versus Q3 22, they did increase their top line by 8.5%, bottom line quite dramatically, as well as some other metrics. So they have improved from essentially the last year, but you could argue they're not keeping up with analysts. But then again, personally, I don't pay too much to what analysts say. It is always more important to ensure they are increasing from the prior year. One thing that I did want to make clear was that I did mention this in the previous Alibaba video where Jack Ma was looking to sell some of his shares. Now, what we can see is he's actually now put off these plans to sell hundreds of millions of shares due to the fact that essentially the tech stock has plummeted and therefore he doesn't really want to be selling at these low prices. What he was looking to do was offload, for those that are interested, around 10 million worth of shares, worth around 871 million in fact. And what we can see is because it's fallen below his expectations, he's not sold a single share. But it is something just to bear in mind that he was looking to sell quite a significant number of shares. So that's the top line analysis of the company. Now we can jump into the valuation. And as always, if you enjoy the content, values being provided, don't forget to smash that like button, hit the subscribe and bell button so you are continually notified. And if you want to grab a copy of the model to get to the intrinsic value and acceptable buy prices of companies in your own portfolio, then do click on that pinned comment below. Now jumping off with the first model, we have Graham's valuation. We have the earnings per share, growth rate per analyst estimates, and that current yield on AAA corporate bonds. This gives an intrinsic value of $103, and when we take a look at the current trading price, that is some significant growth to the current trading price, but do note it's still within that 52-week range, so we can see how big that range is, minimum 70 with the high at 120. But also do remember we never look at any of these models in isolation, and we will draw conclusions towards the end. We then have the multiples valuation, stock price, earnings per share. We essentially get the average PE of these companies, earnings per share multiplied to get the bar stock price based on the multiples of 137. Again, in fact, this is not only some strong upside to the current trading price, but above that 52-week high. We then move on to what would typically be the third model, the DDM, dividend discount. But because they've only started paying dividends just this year, this isn't one that we will use for today's episode of Bar. We then move on to the fourth model, and the third one we're using, the DCF model, with our free cash flows year on year. Average growth rate around 30%. Now, forward-looking analysts are estimating higher than 3%, and that is essentially a lot lower than last year's growth. But I do want to be very conservative here, so I have gone for 3%. With the present value of our future free cash flows and terminal value derived with our discount rate, we get the essential sum, add the cash, subtract total debt, get to the equity value, divide by shares outstanding to get a DCF price of $245. Now, this again is above the current trading price and is above that 52-week high. Now, in terms of the intrinsic value, remember it is just the average of the models that we've dived into in today's episode, and it comes to around $162. Now, I don't need to tell you that, but that shows some signs of severe undervaluation here. And what would typically we'd start off with a 10% margin of safety, it would be a buy up to 145. Now, 10% is what we use purely if we believe it has a wide moat, strong financial metrics, good forward-looking data. But what we are doing today, given the essential risks that we have gone through, there are a lot of risks just with this company being in China, so something just to bear in mind. They are looking for a much higher risk to reward ratio. At 40%, I still believe it's a buy with that margin of safety. At 50%, still a buy. And 55%, pretty much bang on the right price of today's price. So you are getting a 55% margin of safety. And what Wall Street believe, well, they also see some significant upside, just under 100% upside, in fact, to the current trading price. However, as we know with this company, there are a ton of risks involved, so it may be something that is really off-putting for a lot of investors, but there are also investors who do like the risk reward. They see that yes, there is a lot of risk with this company, but the reward, the undervaluation of the company, the essentialness of the balance sheet, they have a very large cash position. They could pay off essentially their debt whenever they wanted to. But again, it does come down to the individual investor. So let me know your thoughts in the comments below. This is one where a lot of investors do clash on their thesis of whether or not to buy or sell. And there's also a lot of bearish as well as bullish sentiment around Alibaba. As always though, let me know your thoughts. I'd be interested to know if you believe this is a buy right now or if you've already been accumulating. And don't forget, if you enjoyed the content, smash the like button, hit that subscribe and bell button so you are continually notified of these videos as they regularly drop. And finally, click on that pinned comment below so you can grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio. As always, have a great day and catch you all on the next episode.